Okay, let's talk about financial leverage and this debt to equity ratio with an example. So in this example, we're talking about an all equity firm. Yeah, an all equity firm is 100% stocks, and we're considering going into debt. So we're going to borrow some money and use that for the company. So some of the original shareholders might want to cash out, etc. is a possible example of this. So currently we have $20,000 in assets and no debt. We have $20,000 in equity. The debt to equity ratio, of course, is 0. There is no interest rate. There are 400 shares outstanding at $50 price. What we propose is a debt of $8,000, $12,000 in equity for the $20,000 total assets. The debt to equity ratio is 2 divided by 3, debt to equity. So if you think about that, debt to equity, what is debt to equity? Well, if you take the 20,000 and you take it into parts, right, 4,000 at a part, there's 2 parts 4,000 is 8,000, 3 parts 4,000 is 12,000, 2 over 3 debt to equity ratio. Now the other way you could do that that's simpler is if you look at the debt and the equity, and you combine them to 20,000, and the debt is 8. You have 20,000 total, and 8 is debt. Then what's left over has to be the equity, which is 12. So you can look at it either way. Probably the simpler way is to say that the firm is valued at 20,000. You have 8,000 debt. Whatever's not debt is equity, and that would be the 12,000. But you can see how it works into a 2/3 relationship here. Anyway, the interest rate on the debt is 8%. Shares outstanding are 240. So we sold 160 shares at $50 a piece. 160 times $50 is the $8,000 that we have in debt. So the bank loaned us $8,000. We took the $8,000 and bought 160 shares. We retired those. Nobody has those shares anymore. So now there's 240 shares remaining, and the price hasn't changed. It's still $50 for the share price. So let's go to the next slide here and look at our economic conditions. Our recession, expected economy, and expansion. EBIT for each is 1,000, 2,000, 3,000 respectively. Interest under the current structure is 0. Net income would be 1,000, 2,000, and 3,000 therefore. And earnings per share would either be $2.50, $5, $7.50. And return on assets would be 5, 10, and 15, as would return on equity. And of course, this is based on 400 shares outstanding. So this is under the current structure. This is what you would expect. What if we add debt? Now remember, debt is going to provide leverage. So if we add debt with the expansion here, this is under the proposed new structure. We have EBIT, which is 1,000 under recession. We have EBIT as 1,000. We have interest of 640, which reduces our net income to 360. Our earnings per share, therefore, because there's 240 shares, are $1.50. Our return on assets is 1.8%, and return on equity is 3%. So as you can see, the previous slide had $1,000 doing pretty well, or an EBIT of $1,000 doing pretty well. In this case, a recession of $1,000, because we have the debt, we don't do as well. In the expansion, however, if you go to the expansion numbers, $3,000 of expansion, interest 640, net income is 2360. You can see that earnings per share, return on assets, and return on equity are significantly higher, are absolutely wonderfully higher. So we really like debt in expansions. We really don't like debt in recessions or contractions. So if we look back at the previous numbers, I'm going back up a slide here to see that we were at 5, 10, and 15 for return on assets and return on equity. And if we go to this slide, we can see that its return on assets are 1, 6.8, and 11.8. So instead of 5, 10, and 15, it was 1.8, 6.8, and 11.8. But the return on equity for the shareholders was 3, 11.3, and 19.7. So even in the standard case, the middle case, we were at 10% return on equity. We added some debt, and now we're at 11.3% return on equity. And because we have that return on equity higher, we have added to the overall average value of the firm, which means adding this debt would be valuable to us. We can also look this as a chart in a graph, in a line graph. The earnings per share is in the vertical axis. 2, 4, 6, 8, 10, etc. And the EBIT in dollars, no taxes, is in the horizontal axis. And the disadvantage to debt, you can see, is below the break-even point, is about, I don't know exactly what number that is. That's probably, what, 1,700 at for 350 per share, something like that, in the break-even point. And then above that, you can see that debt does provide an advantage in earnings per share above that. So the adding the debt makes the line steeper. It takes the line and moves it steeper. So the result is going to be better on the top end and worse on the bottom end. So if the red line here is no debt, and if we take that red line and we steepen it, we're going to get a better result on the top end and a worse result on the bottom end. That's what the advantage of leverage is. It magnifies your results. So to a certain point, we like leverage if we're going to have good earnings and a good future. We definitely like leverage because we'll get a better result. If we're going to have a bad future, if we think it's recession and so on, then we want to reduce our debt and we want to reduce our liabilities in that regard, because it will impact us negatively more. It will be magnified more than otherwise. So this was a business case. Next, let's take a case we've done before, I believe, but let's talk about a case of home ownership, and I think this will hit home even more.